Well, good afternoon, everybody. This is Mark Robertson coming to you from beautiful autumnal northwestern Illinois, where I'm back in my hometown working on the sale of my parents' house and basically getting it prepped up and ready to go and dealing with multiple bidders and all kinds of real estate turmoil. Those of you that are in the real estate business or know someone who is know that it's not always easy, but it's going well and we're very hopeful. I'm joined here today by our dear friend Hugh McManus, coming to us from the shores of California. Good afternoon, Hugh.
Hey everyone, still good morning here.
It is, you are still good morning. And if she's back in the room, we have as our special guest Tim Butcher from Evansville, Indiana, by way of Florida these days. Did you make it back in the room, Kim? She may still be on her way back, but she will be in the back room handling questions and taking care of things as we go. Well, welcome to this 14th session or episode of Bull Sessions, where we are going to talk a little bit about, I think, a fairly powerful story that I have with respect to helping a person find a little bit of the promised land, at least so good so far. And it's framed around this bare naked million that some of you know about and some of you are going to meet for the first time here today. And then we'll progress into the Leonard Nimoy moment there with that $5 million currency in the middle of your screen. Talk about that for a minute. And then we're going to launch a discussion or a theme. We'll get started with it and it'll probably continue. It'll be kind of fascinating to see where it goes about the 7 deadly sins of investing and could morph into true confessions. We do have a hope that it doesn't wreck our PG-13 rating. So we'll do our best. Get the quick legal paperwork out of the way. No investment recommendation is intended. Everything we do here at these sessions are intended to be education, illustration, and most importantly, demonstration of philosophies and methods of the modern investment club movement, whether that's manifest investing or the National Association of Investors, also known as Better Investing. They are our opinions. We will tell you if we have holdings when we remember to do so, but just keep in mind that that can be the case. We do a monthly webcast on the last Tuesday of every month, coming up on, I think it's on October 27th this month, known as the Roundtable or the Investing Roundtable. This month, I am fairly certain we will be focusing more than usual on smaller, faster growing companies. We usually do for the October session, and that's always been pretty rewarding over the years. If you'd like to be added to an email reminder list about any of these sessions, especially the roundtables, send an email to nkabula1@comcast.net or go to the Mid-Michigan chapter page online, and you can actually do it yourself right there. If you have follow-up to this session, or if you'd like a copy of the slides, we do put a copy of the slides in the Manifest Investing forum. The vast majority of you out there are subscribers to Manifest Investing, but anybody out there is welcome to send me an email, markr@manifestinvesting.com. Okay, just as a point of framing what we're doing here, we started doing this on every Tuesday afternoon. It's kind of my excuse to take a breath from crunching numbers and perhaps present some of the stuff that we've been seeing, but certainly attempt to talk about things which you guys want to hear about and certainly things that we want to talk about. And it could be in any realm with respect to how it might affect investing. We keep a queue of topics. So if you see a topic on there that interests you, and you're welcome to bring one. Basically hearing from a couple people every week that have something that they want to throw on the hopper. Today we are going to talk about Lady Di and the Bare Naked Million saga, and then he was going to introduce this topic of 7 deadly sins of investing. And Hugh, I think you'll notice that a couple of our topics from last week are on that rundown, the buybacks question and China and Japan, and especially the Japan. Did you have any thoughts or things you wanted to add at this point?
No, not at the moment.
Okay. Let's go ahead and crunch into the story. we will have some fun with those topics as we go. Kind of the slide for the week is just a reminder that just in all of the turbulence that we have these days in the stock market, it has managed back to all-time highs. The return forecast is measured by the manifest investing median return forecast. That's the median par, known as my par, has actually drifted all the way back down to approximately 8%, somewhere in the 8-ish range. And it's not quite at the lows that we saw back when it got down into the 5 to 6 range a couple times in the last few years, but it's come down fairly rapidly, suddenly from that peak that you see back during the fairly excessive March turbulence. Somebody asked me to put together a side-by-side of how this number changes from week to week, or how these numbers change from week to week. So you can see that you basically have the Wilshire 5000 index fund. That's the price that's shown, but notice that the return forecast as designated by the projected annual return, fluctuates a little bit. Quality, I'll leave this one off for next time because that doesn't ever fluctuate. The average is always 50. But notice that this one fluctuated down a little bit. Notice that the relative strength index, because of the increase in stock prices over the last week, has actually jumped up to where it's less compelling, more slightly oversold, if you want to think of it that way. Notice that the stocks have moved up in their 52-week position. The only way that changes is if stock prices go up in general, or if the target prices or low prices change around a little bit. A little bit of drift down in the value line return, and again, just a little bit northward movement. Stocks are a little bit less on sale than they were a week ago, and that's shown in that one too. So we'll probably throw that up a few times for display purposes and show how those numbers move around, but kind of fun to look at. Let's go ahead and talk about this bare naked million portfolio. It's one that we really don't talk about that much. It percolates along in the background. As you can see, it actually was created right around Christmas 2006. I think it was the day after Christmas 2006. And literally, I was sitting at my desk and the phone rang, and it was an elder gentleman basically saying, and this had actually happened to him, so this is kind of a cool story. So he asked, what if you were given $1 million? And the type of stuff that you talk about at Manifest Investing, what would you do? And I basically responded that, well, if that actually happened to me, a lot of people talk about phasing that money into the market and tiptoeing and all that stuff, but if it were me, all I would do is take about half of it and put it into an index fund that I trust, one that's got a little bit of robustness to it. And the one that we picked out that day was the Vanguard Growth Fund. It was an exchange-traded fund, and you'll see here in a minute, VUG. And then the rest of it I would take and spread it out amongst some world-class, excellent companies that basically are on sale. So we ended up with that Vanguard Growth Fund in combination with an investment in 9 or 10 companies totaling up to $1 million. Well, 9 years after that Christmas in the Christmas season, 9 years later, that $1 million had grown to 2.56 million. You see the number there, and it was an annualized total return of approximately 11%. That's actually not terribly flashy. It's good. It's really great. It's comfortable. It's warm. It's a good moment by the fireside in a chilly winter. It's good stuff. The stock market over that same time frame had gone up about 6% per year. Okay, so kind of a neat thing. And again, it was we just kind of threw it in the VUG, Vanguard Growth Fund, and pretty much left it in those 9 or 10 companies and placed it on autopilot. All right. So let's fast forward again to a moment in October 2016. Shortly after that update would have been done. And this notion of this bare naked million, it might be one of the most important portfolios that we never talk about in terms of the demonstration portfolio. And what came up was, and it's exactly 4 years ago, because as we were preparing to vote in the presidential election about 4 years ago, a group of friends and neighbors and I were huddled and literally around a bonfire in the backyard talking about all of the pundits expecting the stock market to absolutely crash if a certain person was successful in the general election. And, you know, they asked me what I thought. They all knew that I did stuff with stocks and stuff. I said, you know what? I have no idea what's going to happen. Longer term, my gut instinct is everything really has been kind of in the doldrums, but improving. And, we just kind of talked it through. So one of the people there actually approached me, friend of the family, and described the situation where she'd had this nest egg for a number of years. I've written about it a few times in at Manifest Investing. It's a couple $100,000. And she had actually had that with some brand name brokerage firms in a managed account. And, a long string, which I later learned was actually more than that. This had been going on for, I believe, 12 to 16 years, and it actually was originally $250,000. So in a market that had actually been fairly robust, she had managed to lose about 20% over a period of that amount of time, despite the fact that this was in some places all of you would recognize. And so she brought over the statements, and I was greeted by this tactical asset allocation and 10 to 12 transactions every week. And this nest egg was going nowhere. And so let me tell you a little bit about her. She's an engineer. She's tenacious. She's skeptical. She'd obviously been somewhat injured by this experience. She wanted to believe that the things that I talked about when it came to investing were nothing short of riverboat gambling. She heard the stories about investment clubs, all that kind of stuff, but this portfolio kind of caught her attention. She was extremely skeptical about it. So I showed her that previous slide, basically, and I said, that's it. And then I pointed out to her that at that point in time, there had been 2 transactions. We sold the Jensen Fund and we sold Fastenal. And so she's sitting there with this nest egg that had gone nowhere in years. And we did the math. And again, she said to me, is that something that can be guaranteed? I said, no, we'll talk about that in a minute. When she realized that 200,000 could have been 500,000 just by doing something like this, literally the blood drained from her face and she left my office. So I'm sure some of you have stories that you've heard from people. Some of you might even be able to relate, but it was a moment. So she was trying to come to grips with this presidential election and her frustrations over the years, and this portfolio really was tugging at her heartstrings. So she turned around and basically implemented it. And it is time for an update. And this is not bragging or anything else. This is just simply sharing experience. It's been 4 years because we're getting ready to vote again. And that's not her on the upper left, but she is kind of fond of, on either her phone or her iPad, doing a screenshot and sending me her portfolio. What she proceeded to do, again, I told you she's an engineer. She's very thorough. She's tenacious. She's really fun. And rather than VUG by itself, she wanted to select a blend of QQQ, which is the NASDAQ 100. And then she wanted to use VONG, V-O-N-G, which is very close to VUG and the VUG, but she wanted to demonstrate that she thought that one might be even a little bit better. Like I said, she's fun, a lot and entertaining to be with. And she also wanted that S&P 500 exchange traded fund, SPY. And we had some talks about equal weighted stuff, so she threw in some RSP. That's also the S&P 500, only it's equally weighted. And then she followed our all of the above suggestion and also invested in a highly rated small company fund at the time also. And for some of her play money, she included a little bit of Apple, Amazon, a car company who shall go nameless because neither she or my wife work at that company. It's a 4-letter word in Detroit, so you can probably figure that one out. And Salesforce.com, ticker symbol CRM. There have been very few transactions. I think she sold maybe 2 stocks and maybe switched around 1 fund over the last 4 years. And for a bonus, she and her husband mirrored everything that they did here with their 401ks. Of course, the punchline is here. She's discovered successful investing. So far so good. Again, I have no idea what tomorrow holds, but her annualized rate of return on this nest egg is now 21.8%. That's annualized since October 2016. And obviously she has at least a confidence that investing is now possible. And I'm not so sure that this wouldn't have happened without her scratching her head over the bare naked million. Now, over that same time frame, the Wilshire 5000 has gained about 12.6% a year. So you can see she's beating the market by 9%, 9.2%. And I can remember to this day, the series of questions that you see there. Can this be guaranteed? Can the market be beat? And I told her at that time, you know the answer to that. There aren't any guarantees here. Anything can happen, but again, speaking engineer to engineer, the probability that you'll beat the market is non-zero. That's all she needed to hear. Basically, no promises, but the reality that it could happen. You have to allow it to happen. And, march into it with some confidence. And I really think our community does that day in and day out. And it's a whole lot of fun. Any questions or thought on that, Hugh? Or Kim?
No, it's kind of surprising that you can get incredibly well educated in a whole slew of areas, but not investing. And it's not that you're simply not educated at all, almost totally ignorant of something that is, for everyone's life, quite critical.
Yeah,
I was just going to say that what Munger always said is human behavior is they can't do nothing. And that's the best thing an investor can do is sit on their hands and do nothing. Because look at your returns, because you sat and did nothing compared to the other one that did 10 or 12 transactions a week.
Yeah, and a lot of times I think the people that are managing money do believe that they think they have to do things in order to appear to be doing something. And in fact, back when I was with the National Association, I served as an expert witness in cases of where they were basically being accused of churning. Now, I don't know if that was churning or not. I actually don't. I couldn't figure out, who was really benefiting, if it was, if there was anything unseeming about what was going on. But whatever was going on, it wasn't working. And again, as an engineer, you got to figure out a new and better way. So, lots of good fun. One of the things that she's had to say, and it kind of ties into our recent discussions here over the last several weeks, almost going on a year now, is she has Salesforce.com in there. And the reason she has it in there, because she works in a number of capacities where she works with a number of companies who all use Salesforce. This is a very well embedded company with many companies. And as many of you know, they just joined the Dow 30. They're just kind of cranking along. And her message to me is, whatever you guys are doing, and she goes, I believe what you guys are doing. And she and her husband, who's also an engineer, have studied the analysis techniques and methods and all that. They say, that stuff is spot on, but it's not working here. Salesforce is better than what you're illustrating. So I thought what we could do is take a quick look. One of the things she always points to is like, and this is something that we're critical sometimes. I'm trying not to be nasty, but I want to be constructively critical. She would be one to point out that point's in the wrong place. That's the value line 3 to 5 year forecast. Based on that long-term trend, I don't care who you are, that number's off. It's unusual. That doesn't mean it's wrong. But unless you've got a reason to believe that there's going to be some steep plateauing at Salesforce, that's just not a forecast which is understandable, perhaps not even credible. And that starts the whole ball with a value line based analysis of an early stage company headed in the wrong direction. That's my personal opinion. So as many of you know, we've talked about this concept of using cash flow or projected return on value. And all I'm showing here is the cash flow over time. And the earnings actually don't break and go positive to here. So notice that the cash flow starts going positive basically 4 or 5 years sooner. in the life cycle of this company. And then here's the cash flow margin. That's not the margin based on earnings. That's the margin based on cash flow. And it does seem to be stabilizing somewhere up in this range, to where if you're trying to do an estimate on the company, trying to build an analysis, it would not be that unusual to use something in the 15 or 17% range for the cash flow margin. So it can be done. And again, her criticism, again, meant in the spirit of, let's all try to learn something here, fits with a lot of what we've been talking about. Okay, this slide goes back to one that we had done approximately a month ago on Tesla and Amazon. And I'm kind of falling in love with it. Hugh, I know that we had a lot of fun with Tesla and Amazon as we both scratch our heads as to what did we miss with Tesla? What might we have done when? You know? And what you're looking at here is just the quarter by quarter progression, you know, with the value line reports. And I'll start right down at the bottom. You know, the bottom line, the low total return forecast as projected by a value line, it never gets terribly exciting. In fact, that's basically stuck in the sell zone, if you will, right? And if you look at a projected annual return based on cash flow, not earnings, you get numbers which are a little more to her liking. Those still are not sexy enough for us to get excited, but that one's getting there. The 8.4 that you see back in January 2019. And unlike our analysis of Tesla and Amazon, you don't find a moment with the projected return on value that gets terribly exciting either. Except from what we know from looking at this parameter now, this is basically saying that Salesforce over this time frame has not been as oversold or overvalued as you think, as many people think, and certainly not for the effect of these numbers. Okay, so again, you've got an opportunity to look at the total liabilities over time and how that's going, the amount of cash that they have on hand, and all the considerations are here. Bottom line is it's not as oversold. It doesn't have quite as low a return forecast as most people would think using a conventional analysis. It's kind of fun to watch how it drifts around over time. You can see the progression of the sales growth forecast over time. And it's really kind of a neat way to look at a company. I suspect we'll be doing a little bit more of this as we go. Any thoughts on that?
Yeah, it's always been a challenge to find those companies at the early hockey stick stage when there's actually most risk, but you know, there can be substantial return.
Yeah, you can see kind of the hockey stick taking off, you know, somewhere in here.
Yeah.
And that's what.
Well,
Go ahead, Jim.
I just was looking at, when I looked at it, the biggest thing that struck me is I kind of always say that cash pays bills, not earnings. And if you go back to your other slide, Mark, look at the cash flow margin, projected cash flow margin, 12.6, 12.2, 12.8. They're getting everything going, and now it starts firing on all signals. 14.6, 14.7, 14.4, 16, 17, 16.9, 7. They're getting much more efficient where the cash flow is dropping more and more to the bottom line.
Yeah, the economies of scale are kicking in. These guys are pervasive, omnipresent almost in the industry. So again, that's just kind of a way to look at these companies over time. And then she encouraged me to take a look at, she doesn't do charting. She really does kind of stick to the fundamentals, but looking at a multi-year, I think this goes back 5 years, a stock price chart for Salesforce. I know the time when she was writing me to make a purchase, well, you know, started here. She's talking about it here. Notice the relative strength, pretty attractive with the stock price down approaching 100 at the time. And then back in here, but I can also remember a time frame in here somewhere where the stock price had been just sagging away, and and the business is firing on all cylinders, and we're in the middle of that hockey stick that you just described, and things are taking off, but the stock price is going down. At some point, our experience tells us that that can be a time for a buying opportunity if you think that the company is going to continue going forward. Lo and behold, when you look at a chronicle, it manifests. You have this moment where, again, all of the cylinders are beginning to fire. Look at the quality, basically ramping up now. It's sagged. Notice that the stock price had been stuck in the mud for over a year. That thing has taken off, and yeah, the return forecast at Manifest actually did hit a peak in late 2018, early 2019, and it might have been an interesting moment to not miss. And again, I'm just looking back with hindsight. That's going to be one of the violations here in a minute, probably. When he was talking about sinning, but I find it compelling. She's just basically saying, got to keep working at it until you figure this one out, because companies like this, companies like Tesla, companies like Amazon, they can be very rewarding as non-core investments. You know, keep trying to figure that out. So that's all we need to share on that. All right, and for our update here, by the way, this is Hugh McManus inspired currency. $5 million bill action there from his buddy Spock. And reminisce about that here in a minute. But this is the current condition of the bare naked million. And I actually made the 7th transaction in 19 years. Here within the last couple of weeks, sold off a couple of laggards and moved all of the proceeds into the Motley Fool Small Cap Growth Fund. For many reasons, including the fact that it's got a decent growth rate and it ranks near the top of smaller company growth funds, and we like many of the stocks in their portfolio, so we'll ride that one for a while and see what happens. It's actually up 24% annualized over the last couple of years, so pretty confident that Bill Mann has a handle on what he's doing, and we'll see how it does. So would you like to reminisce about Spock for a minute before we launch into sinning, Hugh?
All right, just trying to figure out how to use a mouse there. No, I'm a huge fan of Spock, as you know. I would say that, in my case at least, and I've learned to become more and more emotionally detached from investing, but I'm still not sure if I'm even close to where I need to be. But it would be great to have the mind of a human, but the emotion of the silicon chip. Mixing carbon and silicon together would be nice, so that I could become a better investor, because it's really very hard. And the 7 deadly sins go into this in a little bit of detail, because the actual 7 deadly sins involve many, many emotions, which are anathema to anyone who's doing investing. It's really, really difficult to buy when everyone is selling.
Yep. So is that our segue away from the fact that we're celebrating 5 million here?
No, I would stick to the 5 million. I think that's really impressive.
Yeah, that's 15 years. I mean, if it's only 12%ish, 12.6% per year, but I'll take that as an only any day. But yeah, I think it does come down to the emotions. Take us away into the 7 deadly sins thinking.
Yeah, we were talking about this recently. The fact that this is actually not a bad summary at all. What this guy has put together. The 7 deadly sins, in Christianity at least, are not actually listed anywhere in the scriptures, but they have been identified by various different sources, and have been used for people to examine their conscience and guide their behavior for generations, for hundreds of years. But Mark and I were actually talking about this. How would the 7 deadly sins, or what would the 7 deadly sins of investing be? And I think this is a great list here. I don't know what your thoughts are, how you change it or whatever, but a lot of it has got to do with being emotionally detached from investing.
Yeah, and I'm not sure where we go with it either, other than to just point out that, I can relate to many of these, um, to avoid sloth, obviously, and awareness of what's going on. And I certainly have lusted for investments. Uh, in fact, some that are probably not as suitable for things. And I've also witnessed anger and wrath or almost revenge type behavior. When a stock, I've told the story, and I know I'm not supposed to speak about people who are in heaven, but I'm going to do it anyhow. Ralph Seeger used to drive me crazy. If a company disappointed us, basically fell victim to the rule of five, but it was one that he'd been using in client portfolios. And you know how they did the repair shop back for Better Investing magazine?
Yeah.
They'd send over the draft, and he'd be, ripping away at this company. And I'd get him on the phone. I'd say, well, Ralph, I'm not going to talk to their lawyers. And if we publish it like this, and then he would growl and, talk about how they harmed him and had nothing good to say about this company anymore because it had gone bad. So there's a case where anger was certainly clouding him from going back and, reconsidering the company. So, I mean, this stuff is real. I mean, emotions, when a stock stings you, I think we're all guilty of wanting to tuck it away and perhaps forget about it for a lifetime. So, I mean, this emotional stuff is not easy.
No, not easy at all. See, one of the things I've been struggling with is fitting in something into what the seven deadly sins of investing would be, fitting something in that I think is generally a weakness, and that is being overly conservative. I mean, I think it's great to have a very conservative nature when it comes to investing, but when it infiltrates everything or every aspect of your thinking, then it becomes bad. And the example that I gave to you, Mark, was that on and off, I've always used margin, particularly when I can't afford to buy something, the price is very inviting. I've done irresponsible things with margin, but never actually suffered from it. In other words, I've margin way up higher than I should have, but I managed to get away with it, and a huge element of luck there. But my regret is doing that, I guess. But my other big regret is actually not using it more, because it really turbocharges a return if you use it correctly. And I think it's a sin to shy away from using margin, which is borrowing from your broker to buy shares of stock with a warning that if you drop below the broker's requirements, the maintenance requirements, you get what's called a margin call. And when that occurs, you either have to put cash into the account immediately to get back up to where you need to be, or sell shares of stock. And if you don't do either of those, then they will make the decision for you, and it may not be, and it will not be tax advantage for you. They will just sell to make sure that their maintenance requirement is met.
So Hugh,
I just think our conservative natures, we shy away from that and say it's bad and evil and wrong and horrible.
yeah.
And I think it's a good point for credit cards and for financing your day-to-day living. But I just wonder if we had a frank discussion about the use of margin, the use of borrowing responsibly to buy shares of stock, if that's not appropriate.
Yeah, so really it's only gluttony if it gets out of control. And if you start doing reckless stuff like the stuff that you're reading about some of the Robin Hood investors now. And in fact, I did give you a true confession the other day. I think I can do this openly without the NEIC gods of investing coming down upon me. Back in the very early days of our Chicago-based investment club, I modified the partnership agreement to permit margin.
Mm-hmm.
I know some of you out there are just chilling and cold and, thinking that lightning is striking me right now. The only reason I did it was to handle back in those days. This is a long time ago for the young people in the audience. Used to have settlement periods and multi-day periods between selling and funds and transactions moving around. The only reason we did it was to cover that for when the club partners' checks would actually make it to Schwab or whatever. And it was only done for that purpose. We didn't do any basically buying stocks on margin. But we did have that margin consideration so that we could do the transactions. And I know many people reacted when I would tell them that as if we were doing, or taking a bite of the forbidden apple or something. So,
Yeah.
There can be reasons for doing that. So again, understanding the risks involved, and it comes down to me, education and that emotional element of, staying in control. So it's not gluttony if you don't go too far. I think I just justified myself.
Yeah. Well, I think it's very reasonable, and margin rates today are incredibly low. I'm talking about interactive brokers where it's 1 to 2%. It's lower than the dividend yield in many companies that I own. Yeah, it's not to be used irresponsibly, but when I'm presented with an opportunity to buy a company at a once in a lifetime discount or a once in a decade discount, and I don't have the cash to do it, there's a dilemma there. What do I do? As long as I'm sure the earnings engine of that company is intact, nothing bad will happen to it, and I don't invest a huge chunk of the portfolio or borrow against it, I've always been comfortable doing that. I don't think it's a sin.
Yeah, and it comes down to making sure you know what you're doing, and I don't know. Perhaps we can find a way in future weeks to weave this into an unwillingness to take advice, or this notion of holding on to stock for too long. I mentioned to you the Josh Brown series that we could take a look at and see how some of the stuff that they talk about. I know one of them fits. We hear an awful lot about diversification. And technically, the way that we teach investing, we're anything but diversified, really, by the classical academic definitions. And, with 12 or 16 stocks, you're just not, compared to what even a regulator would expect. They would say you're very concentrated. That's basically, in their eyes, a sin. And perhaps we could pull out some of the works of Phil Fisher, who thinks that's the right way to do it. I know you're a fan of Phil Fisher.
Mm-hmm. Well, diversification is another one where I feel I'm sinning by not being diversified. I've never been diversified. I keep at this for another, I would say, 130 to 135 years. I should get to well diversified at that point. But I'm not making any effort to be diversified. And when people call, particularly on LinkedIn, people will look at you and they'll say, oh, he might be a soft touch. So you'll have these investment advisors calling you to offer their services. And one of the pitches that they always make is that they will ensure you're very well diversified. And I ask them why. Why do you want to do that? And if you think it's very valuable, why would I need you? Because I would just buy an S&P 500 index that has a very ETF, even something with no transaction costs, or no direct transaction costs, and be diversified that way.
Sure. Well, Kim, I don't know.
I don't think that's in either, by the way, but who am I? I haven't been ordained an investment advisor, so.
Kim, I'm sure you don't do any direct sending, but do you have any knowledge of any friends or colleagues that would fit any of these that you would like to discuss?
That fit any of these sins?
The sins, yeah.
Oh, there's no question. I mean, the thing that, now I'll get angry now, so I'll commit sin number 5 here on the list. The thing that makes me angry, quite honestly, is in the 1990s at NAIC, tens of thousands of people walked through the door to listen to what NAIC had to say, attended many events, cheered. They were Alleluia choruses. They believed exactly what was being taught. And then after a few years, they all left and didn't practice it. And they actually joined the organization, perhaps arguably at the very wrong time, when the market was headed towards a very nice high. And they all scarpered in early 2000 into that whole period up to 2008, 2009, and maybe even continuing today, when they really should have been diligently investing, and they would have made spectacular returns.
Yeah.
One of the caveats I always used to tell people, particularly if they were in clubs, is that it takes 5 years, not always, but you should be willing to invest at least 5 years in a club to get to the point where you have a positive return, or at least that you're getting close to a place where you're comfortable saying you can beat the market. but it does take 5 years. But unfortunately, many people didn't even last that long.
Yeah.
I'm sure they lasted more than 5 months, but they headed for the hills.
Again, it comes back to human nature and perhaps even some emotions getting in the way. Kim, any thoughts?
No, I mean, I probably could say that I've probably done each one of these myself.
Yeah.
But then I've known others who have done it too. And I think we each as individuals have to understand our own biases. You know, our bias of making the excuse that we don't follow our stock, or the bias of saying, I don't think I'll ever get in the housing market because they can never make money. And ultimately, you challenge yourself, you get into it. And I would have never have thought that a stock that I picked one time, won at Manifest, because I challenged myself to break up my biases. Because a lot of times as individuals, we don't know our own biases. I mean, I could probably tell you a stock on each one of these I've screwed up on.
Well, that's what we're
All
going
of
to
us are human.
Yeah, we're probably going to take a shot at that. In fact, I'm going to invite the audience, if you have a sin or an accusation that you want to make, we welcome the opportunity to discuss that in future sessions. Just give it some thought. It really does come all the way back to that self-control and the emotions and the education of learning what we're doing here. That's how you take risk out of investing anyhow. Let's go ahead and press on, but yeah, please, if you've got stuff that you'd like to talk about, just a reminder, especially if you've got some friends out there that you want to expose to this type of soul searching. We are on YouTube. You can simply search Manifest Investing. That'll take you to the page. We would greatly appreciate it if you subscribe. That way you can enable reminders anytime new content is posted. Anytime we hit a theme that really resonates with you, we'd appreciate it. That helps us understand what types of things to focus on. And one last piece of housekeeping before we do open the floor up for questions or whatever. Just a reminder to save the dates. We're going to have our COVID cancellation conference #2. All three of us, Hugh, Kim, and myself, will be on for some of those sessions and panels November 11th through the 13th. So you'll be seeing more information on that shortly. With that, I'm just going to say thanks to Hugh and Kim for showing up and helping out and kicking off a new topic. And we'll get out there and enjoy an autumn day. But I'm going to go ahead and shut down the broadcast or shut down the recording, and we'll stick around for a couple of minutes if anybody wants to explore anything. So thanks, everybody. Good hunting out there.